Today, we'll cover what's the biggest news in the past whole week, the RBI action on Paytm Payments Bank. A lot has been covered in terms of what happened at Paytm, what did not happen at Paytm, the regulatory lapses, and so on and so forth. We won't get into that. What we'll do here is we will do a deep dive into the Paytm's business model and see whether it has the requisite strength for making it a long lasting business. But before we start, let's get one question out of the way. Whether RBI action has some effect on the overall business, the parent company 197 Communications or not? Well, it has, because 197 Communication owns 49% of the bank. So any impact on the bank will have a direct impact on the company's financials, its ability to fund its losses, its ability to grow, and its ability and the overall business as such. So with that out of the way, let's get into the video very quickly. So as we said in our last video also, Paytm as a business model is a very confusing business model. It is trying to do everything, to provide all services, to become a supermarket of sorts instead of focusing on a few things. And it continues to do so. I really do not see any change in there. So what does Paytm do actually? What is its business? First, it started with the wallet and the payments businesses. This was a very valid business model 5 years back when it started, simply because of the lack of interoperability of banks and systems. At that time, yes, it was challenging. If I had a bank account in one bank, then paying money to a merchant directly was very difficult. But with UPI coming in, getting as prevalent as it is, that business model itself is now no longer a viable business model. Simply because now everyone is on the same platform, all the banks are on the same platform, they can all offer what Paytm is offering at a much better costs, because their fixed costs are spread across other services also. So that wallet business is no longer a viable business model. The second business vertical of Paytm is its merchant unit, or the payments unit. Now these are the QR codes which you see at every Kirana store in your neighborhood. Even the vegetable vendor has it. Here Paytm offers them a service wherein the customers can pay directly to their bank accounts or to the Paytm wallets. For that, Paytm charges a small fee called MDR, or merchant fee, which ranges usually between 0.5% to 2% of the transaction volume. Now, this is the erstwhile Visa and MasterCard networks which a lot of outlets used to have, and the credit card machines which all these outlets used to have. So Paytm essentially was trying to replace all these networks. But with UPI coming in and with all the banks becoming very aggressive, I have started seeing ICICI, HDFC and SBI cards and QR codes also in these outlets. So banks, of course, considering that their cost of funds is much lower and they can absorb some losses here, can offer these services at a discounted rate to the merchants, simply to ensure that they get the float and make more money out of it. So scalability of merchant business is a big question mark according to me. I don't see it scaling up multiple times from where it is now. In fact, maintaining it at the present levels is also going to be a challenge for Paytm. The third segment of Paytm's business model, or the third leg of its three-legged stool as of today, is the distribution business. where Paytm is the distributor for loans, insurance products, mutual funds, travel services, and so on and so forth. This business itself earns Paytm a small commission on every transaction as such. This also includes the bill pay facility and all. But my question to you is this a scalable business? Is distribution lacking in this country? I don't think so. With the reach of the banks today spreading in the hinterland, uh, with the public sector banks really getting their act together in terms of their digital infrastructure, I don't think distribution muscle is going to be the differentiating factor going forward. Neither will distribution be a very, very lucrative business. Now, why am I saying distribution is not that great a business? Distributing a product essentially earns you a one time commission normally. If you distribute a loan, banks will give you a one time sourcing fee. If you distribute a insurance product, you will get a percentage of the premium collected. But all these are a one time costs, and repeat rates in any of these is very, very low. My personal experience, I switched out of Bajaj insurance simply because of the amount of calls they used to do me for renewals. I got so frustrated, I moved out. So, it's a one time business. Scaling it will need continuous marketing spends from Paytm side. Where Paytm is not that great at distribution is because it is trying to distribute everything under the sun. Now, when I think of insurance, a policy bazaar comes to mind. When I think of loans, it is a lending cart which comes to mind, not Paytm as such. When I think of mutual funds, a Zerodha, a Grow come to mind because their marketing is very, very clear, very, very effective, and they are focused on one thing. They can hammer it in the consumer's mind that yes, they represent that category. A Paytm is spread too thin across a lot of products it is trying to distribute, and hence its marketing spend is also spread across. So, does it have a top of mind recall in anything else other than payments? No, not really. For payments, yes, Paytm Karo was a fantastic marketing catch line which it branding it developed for itself, and yes, it has a lot of value still. But do I do Paytm for loans? Do I do Paytm for travel bookings? Do I do Paytm for insurance? No, they don't sound right as such. So, what does Paytm do? Out of the three main businesses it had, one was banking services, one was the payment and merchant services, and third was the distribution arm. One RBI really just made it impossible to do business there, made it redundant of sorts. There is a possibility it will still get to do business there, but at this point, it's tough. The second pillar, which was the merchant pillar, still continues firing on all cylinders, but the lack of trust which the first, which RBI action has generated, might we might see some churn there, and scaling it up from where it is today, it's difficult. And the third pillar, which is the distribution business, is it really, really scalable 10, 20, 30 times from here? I don't think so. Is it really, really that lucrative a business? Again, I don't think so. So, what does Paytm do from here when two out of three businesses which it is into are not really working that well? Let's get into that segment now. So, Paytm was on the right track with its payment bank's license. The next obvious logical step was to get an NBFC license and start lending from its own book. That's where the real money is. Take an insurance license and become an insurance company just like ACO did. Or they could have easily applied for a mutual fund license and started an asset management business. These were the three next logical steps wherein a long term sustainable business model could have been built, and these would have been highly complementary to its distribution muscle today. Now, unfortunately, what is happening is with the payment bank's fiasco, I'm not very sure it will be easy for them to get the other licenses, the NBFC license, the asset management license, or even the insurance license. These are all tough licenses to get. But at the same time, had they got these licenses, scaling up for them would have been very, very easy with the kind of reach they have. But as of right now, it looks very, very difficult. So if I was in Vijay Shekhar Sharma's shoes, what I would do to salvage Paytm from here on? First and foremost, save the Paytm Payments Bank at whatever cost. That would be the first step. Get my compliance in order, get my house in order, and ensure that I satisfy RBI and its demands. Once that is done, I would then try and start with a co-lending business with other NBFCs. In the longer run, I would also want to get into insurance and asset management businesses. Those are very, very lucrative businesses and are ideal for the kind of digital first distribution which Paytm has. But that's what I would do. I'm not sure what's in Mr. Vijay Shekhar Sharma's mind. I wish him all the best. I'm all for entrepreneurship in India, and I am all for creating value for everyone. And I hope that this is just one more tough speed breaker and is not a full stop for Paytm. But I have one question here for all of you to think about. Uh, Today, Paytm is a listed company. Technically, it's just a distributor of financial products without the payments bank. And we are assigning it a certain valuation. The market is assigning it a certain valuation, which today is much, much more than the valuation of the banks and insurance companies whose products Paytm is distributing. So, are we saying that the distributor is more valuable than the banks and financial institutions and insurance companies whose products it distributes? If, as an investor, we are considering that the distribution is more valuable than the actual companies and we do not trust their own distribution muscle, I'm sorry, it doesn't work that way. I don't think that's the right way. With that, have you invested in, if you are invested in Paytm stock, I would request you to really think hard about why you invested in it, and then take a call whether to continue holding it or whether to book your losses, sell it today, and invest somewhere else. Maybe in a financial institution whose products Paytm distributes. So, thank you for watching. If you really got value out of this video, do like and subscribe. It really helps me and motivates me to put out more videos like this. Also, do check out my other videos on my channel. There are some very, very interesting videos there. See you next time. Have a great day ahead.